Hello, everyone. Thank you for being here. My name is Max. As I was introduced, I have been in crypto for a while already. I was first focused on interoperability, then started to collaborate with Arbitrum, the biggest layer 2. And over the last couple of years, I've been focused and obsessed over growing the on-chain economy, as in growing the productive value that can come on-chain and enhance what you can actually do and the reason why you stay on-chain. And so let's start from what we have today. For 10 years, we basically built the infrastructure, the on-chain infrastructure. We enabled the creation of assets, of money that can be settled on-chain, that can be traded, that can be moved very quickly, that is ultimately programmable with code, and is accessible everywhere, right? Globally, but also across any protocols, across any market, 24/7. So we basically built these battle-tested rails that are thought to serve an economy. Well, what's the issue? That this economy is still very reflexive. Like every type of yield that is generated on-chain is normally coming from incentives, from leverage, from trading activities. So when that type of trading, when type of speculation slows down, the kind of yield, which is the measure the measure that I use to understand what's the appetite to be on-chain, what's the appetite to bring money on-chain, kind of collapses. Here we can see the graph of the API, of the APY of depositing stablecoin on Aave, USDC. And while in the past years it was around 8–10%, meaning that there was enough demand for stablecoins to earn that type of yield, right now it has collapsed to 2%, which is even below what T-bill pays. This is because as the trading experience, as the volatility decreases, there's less demand for this type of yield. What is the solution? What is the opportunity? Well, the real economy generates yield every day through commercial activities, whether it's invoices, whether it's trade finance, whether it's rentals. Why don't we bring that on-chain? Why don't we bring the real economy on-chain in a way that becomes more transparent and it gets unlocked from the current form, which is stuck in private institutions, in banks, in local markets, and make it accessible to this global pool of liquidity that already exists. So this is what we are already doing. We are creating this sustainable flow that goes from the on-chain liquidity that already exists, that is global, that is poured down into businesses that generate real revenues, and that revenues is then being brought back on-chain in the form of yield. And that's when it gets composed with all the vaults, lending markets, hedging systems that you can think of that is already being created. But this is sustainable because the yield doesn't come from the speculation itself, but it comes from real activity, from the real economy. The market is huge. We have, there's more than 500 trillion actually of the global trade finance, and only 500 billion, only 300 billions have been brought on chains in the terms of real world assets and stable coins. So there is really an opportunity to grow 10x from the current state. Why would people be interested in growing this, deploying this capital on chain rather than using the traditional system? Well, first of all, you get access to global assets that you may not have access normally. Right now, we have a portfolio of around 10 businesses that are doing this type of activities. They're spread all around the world. Number two, once the yield gets on chain, you can compose it with all the different tools and smart contracts and platforms that are already existing. So what we have today is a portfolio of around 10 businesses, as I was saying, more than 20 million in capital deployed. These businesses are specialized in specific industries and areas and geographies. And so here I brought 3 examples that I think are very interesting to explore. One is called Bulla. Bulla is specialized in the invoice factoring business, and in particular in the freight industry in the US. So they work with all the suppliers of Walmart and other tier 1 chains tier 1 retail chains. These suppliers are normally paid by Walmart after 30 or 60 days, and so they need some cash. These guys need some cash to run their operations. So Bulla has an on-chain liquidity pool. When somebody of these suppliers come on chain with a receipt that they have serviced Walmart, they're able to withdraw an equivalent amount of money and use it for their working capital, of course at a discount, so the investors of Bulla, the liquidity providers, make money. Dual Mint is focusing on everyday operational assets for small and medium enterprises. So they work with laundromats, for example. Whenever a laundromat shop wants to expand their operations, they want to buy a new washing machine, Dual Mint will finance the new operation, and then they have a way to track on their machine how much the machine is used. And so for every time that is used, they collect a fee. They bring back that fee on chain and then distribute it to the liquidity providers. Fractalize, I think it's also another interesting example. They are one of the pioneers for the space. They started by renting basically tokenizing a commercial vessel that they rented out. So they basically took a commercial vessel, they split it into small pieces, they sold it in the market, and then they rent out the vessel to a company, and they insure the asset. So basically, an investor is not exposed anymore to the price, to the fluctuation of the asset itself, but is only generating yield from the rental agreement. This is happening across the globe, and now Fractalize has actually moved on into a more operationalized and more like diversified kind of yield warehouse machine, where they're able to wrap any productive assets with high capex, wrap it into a special purpose vehicles, so you have actually legal recourse over the asset, they insure it, as we said, and then provide liquidity to that asset itself. So the investors can actually go in and out of the positions as they want, while at the same time earning a very interesting yield, which is way above what the on-chain economy today can provide. I think the last part that I wanted to mention is that once this yield is coming on-chain, right, we have this flow where we have this sustainable yield that is finally coming on-chain. The beauty of it is that now that yield can also be made a programmable asset. So it can be decomposed into specific risk parameters. The specific risk parameters can be traded, can be priced instantly on-chain. That asset can have liquidity. That asset can be made accessible, as we said, to retails and not only the old institution system. But you can also, of course, you can trench it, so you can have a junior and senior exposure. And you can also do this dynamically, so it doesn't have to be a static instrument, but it continuously can change according to the amount of yield that is coming on chain. There are other risking parameters. You can hedge it against the market with prediction markets. You can have AI agents now depositing funds into this type of assets because it's all on chain, it's all accessible, it's all liquid. So this is what we've been doing for the past year and a half. We are working with, from one side, startups and companies that are tokenizing their cash flow, and on the other side, with the capital allocators that are looking to generate between 10 and 20% yield on their capital with low risk, whether they are fintechs, family funds, institutions, and so on. So if you are into one of these categories, happy to chat. My name is Max. Thank you for your time.
To let people hear you.
There is one thing I don't understand about, this whole process is, how do you ensure that I'm not doing the same thing twice on two different chains? and then like selling the same asset across two different platforms?
Okay, good question. Well, there is definitely like a level of relationship trust with the platform that is issuing the assets, right? If Bulla or Fractalize is issuing an asset, they are the responsible ones, effectively the custodian of the asset, so they will manage the flow to bring that on chain. Once it's on chain, it's like the market will effectively define what the price of those assets, right? And then the liquidity, and then, so if it's liquid and if it's tradable, and if it's associated with a certain price, that will determine the security of effectively the security and the safety of the asset itself. So coming back to your question, there's nothing technically prevents the duplication of these assets, but it's a commercial relationship they are establishing, similar to another off-chain commercial relationship that will determine, that will guarantee the security and the effectiveness of the asset itself. Thank you for the question.
Great. Thank you so much, Max. And yeah, brilliant talk.
Awesome.
Another round of applause for Max. Oh, another question? Is there another question?
Just a comment. We have the time. And if you
Yeah.
can come back to the very first slide where you were talking about the yield versus the total value lock. Like, yeah, that one.
Yeah.
Okay, no, just the point that, I mean, I think the relationship that you were pointing out is like the opposite, if you agree. I mean, the point is that, you know, yields go down when there is a liquidity excess. I mean, people, you know, start borrowing, actually taking, I mean, also the graphs is showing that. I mean, the yield is going down not because people are not putting money, it's like the opposite. We are growing that much, there is so much demand for borrowing and yields from stablecoin, etc., that the yields will go down. I mean, otherwise, if we get super high yields, the more the coins that we want to get the yield from, it is like unsustainable. I mean, the yield is going down because the value, the total value locked is going up, I think.
For sure, that's a relationship correct. What my point was, I want both to go up, right? I want the value to go up, to be on-chain, but also the yield, which is the productive element of the economy, to go up, right? If I look at that and I see 2%, it means that people should actually be parking their funds on T-bills because that generates more, more value for them. So what we want is to increase the amount of funds that is poured into the economy, but increase actually the productivity of those assets. And this is the way to increase the productivity of those assets on top of this basic rate, which is stablecoin lending.
Then so the narrative is like, since the demand is growing that much for yields on chain on plain stablecoin, it is so profitable to go on tokenized asset because there is a demand shortage on tokenized assets.
There is a shortage on the speculative activity, right, which has driven a lot of the yields in the past, right? It is not able to sustain this new supply of stablecoins, if you want, yes. And so the reason, the solution to bring back this productive economy is to actually start tokenizing the real economy on chain. You're welcome. Thank you for your question.
We just have another question.
Yeah. So the product is very, very interesting. My question was, under which regulatory framework are you guys operating?
So each of the businesses that we support has their own kind of framework, their own jurisdiction. So depending on what's your appetite, what's your own jurisdiction, you might want to look at a different type of assets. Bulla operates in the US, they are incorporated in Delaware. Other guys are incorporated in Hong Kong. We have people in Europe as well, Dubai. So each of those companies in the portfolio, they operate under a different framework and structure that kind of may fit you better or not, depending on you. But the good thing is that, it's not some very exotic or unregulated kind of products. They're all very extremely regulated. There are special purpose vehicles. They follow the actual path to make these even legally Just to enable even legal recourse if there was a necessity. Exactly.
And on that note,
I appreciate it, guys. Thank you.
it's lunchtime.
Let's go.